Hello everyone. My name is Maria Thomas and I work for Allianz Research, the global team of economists, strategists, sector advisors, and foresight experts of the Allianz Group, led by Ludovic Subran. Welcome to Tomorrow, a podcast where we'll be talking about our latest analyses of economic and capital market developments, as well as our views on trends affecting risk management. Let's get started. What could a second Trump term mean for global trade? In this episode, we speak to Head of Corporate Research Kuhanathan and Senior Economist Françoise Huang about how a renewed trade war could affect global supply chains and pave the way for new trade champions. Hello, Françoise and Anu. Welcome to the podcast.
Hi, Maria.
Hi, Maria.
So we're recording this just a few weeks after the US elections. So my first question is a big one. What will a second Trump term mean for global trade?
Well, I think everybody is expecting higher tariffs, and that is indeed the new baseline we have for our global economic outlook and our global trade outlook. We expect indeed that Mr. Trump and his new administration will be raising tariffs, but maybe not as much as what some may fear, maybe not as much as what he may have said during his campaigns. More precisely, we expect the US to raise tariffs against China to 25%, excluding some critical dependencies. And the US tariffs to the rest of the world will also rise to 5%, excluding Mexico and Canada. So it's, I would say, maybe kind of a mild or contained trade war scenario. Still, in this scenario, of course, global trade flows will suffer somewhat. For example, for 2026, we were expecting global trade to rise by 5.5% in nominal terms. That's now likely to be cut by 0.6 percentage point. So I talk about 2026 because we don't expect the new tariffs to be imposed until maybe the second quarter of next year. And so probably the most of the hit will be felt later that year and into 2026. So that's the global picture. And then, of course, China being the main target will likely see the highest amount of export at risk. We expect around $35 billion of export losses in 2025 and 2026. The EU also would bear most of the cost. So China and EU together would represent around half of the global export losses due to this renewed trade war. And sectors most at risk are auto manufacturing, transport equipment, metals. And yes, lastly, of course, so this trade war may be renewed and reignited by the Trump administration, but the U.S. trading partners, will also likely retaliate. With China and the EU, for example, likely to target sectors in the U.S. such as pharmaceuticals, autos, metals, agri-food, and machinery.
Will the intensification of the trade war between the US and China diminish China's role in global trade?
We think that China's position in the global economy is mostly fueled by its strength in terms of exports and manufacturing. Of course, for decades, the U.S. economy was unrivaled, but the rise of China, especially in trade and manufacturing, as I mentioned, is kind of now disturbing this previous balance in the global economy. In the past 20 years, China managed to overtake the U.S. to become the world's largest manufacturer as soon as 2009. Also, of course, it became the largest economy in terms of global trade. So these are positions that are likely to be difficult to disturb in the short term, especially considering that so it's not only about the size, but also the intensity of the rest of the world's dependency on China. For a few years now, we've developed this framework of critical dependencies. And we find that, for example, despite the first round of the trade war during Mr. Trump's first administration, the U.S. critical dependency on China actually increased. So before Mr. Trump's first administration, around 5% of U.S. imports were critical dependencies on China. And now the latest data show that this ratio increased to 7%, despite the trade war, despite the pandemic and all the disruptions we've been seeing and diversification we've been seeing in global supply chains in the past years. So yeah, that is to say that, of course, the trade war and other kind of restrictions that the US would put in place against China will make China's future path less smooth than in the past. But China probably has already reached a position in global trade and global manufacturing that is extremely difficult to decouple from. Then, of course, so for decades, the US has been the sole hegemony. And of course, the US also has a strong strength and leverage to use against these trading partners.
Yeah, exactly. Françoise, you're totally right. The US global economic leadership is maybe contested by China, but the superpower still has a strong grip on global trade and global trade flows. To begin with, it's the largest market on planet Earth. So the US consumer is driving a lot economic activity globally and global trade flows. So that remains a strength and a driver for on the US side that is definitely going to weigh in over the next couple of years, and we'll see how the Trump administration will impact the consumer spending and consumer demand in the US. And one other big factor of influence and power of the US on trade is obviously the dollar. The dollar has been declining a bit in its role in global trade and also as a reserve currency, but it still remains the first currency that is used in trade and also the first reserve currency around the world. So by having this ability to weigh in with sanctions and constraints on the dollar, the US also holds a key factor in shaping global trade going forward.
So let's talk a little bit more about Europe, because in your report you write that aligning with the US on trade policy can be very costly for the EU. Can you tell us more about that?
You are right, Maria. The US and Europe have been mostly aligned when it comes to geopolitics and China, but we have seen that from an economical standpoint, the EU should not necessarily align systematically with the US, mostly because we see that the cost for Europe is higher. The first thing that we observe is that when the US impose tariff or non-tariff measure on China over the next year or so, there is over 75% correlation of European measures in a similar direction. So there is a tendency of Europe to systematically follow economic and trade measures against China. But the flip side is that while for the US, these tariffs imposed on China cost to the country about 4% of its Chinese imports. For the EU, it has costed 6.4%. So we're talking about 2.5 percentage more, give or take, and this is clearly an issue for the EU, and we argue that the EU needs to find its own economic statecraft to navigate this complicated landscape. Obviously, it doesn't mean that the EU has to change its geopolitical stance, but it needs to have probably a smarter and a more efficient economic and trade policy going forward. We believe that, for example, the green aspect and the sustainable drive of the EU could be one of the policy tool to design a policy that works for the EU and that is not too detrimental to its economic prospect. If you look at green subsidies in Europe, they accounted for over a third of total subsidies and spending by authorities in the EU. Those could be redirected and maybe reshaped in order to benefit the EU industry and also protect domestic markets and domestic players. Maybe just to give an example, the carbon border adjustment mechanism has been set in place by the EU. And before the election of Donald Trump, the U.S. negotiated an exemption. Those we believe could be again up for discussion, as this is precisely the type of measure that is both going towards a greener economy and also a more resilient economy for the EU.
And in this context of rising trade tensions, how are global trade flows changing?
Yeah, so indeed, in our analysis, we do see that geopolitical relationships seem to be driving trade flows in the past few years. So especially since the first quarter of 2022, we see, for example, that bilateral trade flows between geopolitically close countries have been rising, so plus 2 percentage points to represent around 60% of global trade now. Behind that, in particular, we have, for example, that US imports have been breaking away from geopolitically very distant countries, and that is mostly breaking away from China. Whereas symmetrically, China has been exporting more to its own geopolitically close partners, and those include, for example, Russia, Singapore, Vietnam, the UAE, or Saudi Arabia. So the fact that geopolitics now seem to be playing an increasingly important role in how global trade flows are shaping suggests that global trade and global supply chains are becoming more complex. So here again, we try to quantify this, and our in-house global supply chain complexity index tell us that in 2023, compared to 2017, so maybe compared to the pre-trade war era, global supply chain complexity increased two times. Yeah. And it's even 6 times the complexity that was observed during the pandemic years. So definitely this new geoeconomic order, this confrontation between the two hegemonies that are the US and China, these are creating risks and uncertainties for global supply chains. But at the same time, we also see some opportunities. In this context of confrontation, some countries are aiming to position themselves between the two, maybe, and trying to position themselves as the next generation trade hubs to try to gain from the complexification of global supply chains. So to that end, we gauge the strengths of the different economies, especially in the emerging world. We gauge the strength of these economies, looking at the efficiency of their economy, the efficiency of their financial system, the connectivity of their existing infrastructure, and also their trade potential. So already how much trade and investment market share they've been able to grab already in the recent past. So in this framework, we identified 25 next generation trade hubs. Many of them are in Asia and in fast-growing mid-sized countries that already have quite strong logistics hubs. So, for example, Malaysia, Vietnam, Indonesia, the Philippines, the UAE. And so when we take these 25 economies as a group, we expect them to grow their share in global exports by nearly 2 percentage points over the next 5 years, reaching around $1.3 trillion, so over the next 5 years. So now, of course, by the end of the decade, as these hubs will grow to account for a larger share of global exports, to really reap the benefits of the complexification of global supply chains and to really realize their potential, they will also need to invest in their logistics systems and in their port infrastructure. And on that point, for example, we estimate that $120 billion worth of port infrastructure investment are needed to maintain this growing momentum.
And if the trade war intensifies, what would that mean for these new trade champions?
That's a fair question, Maria. Obviously, when we talk about those new next generation trade hubs, the big question is how do they relate to the US and how do they relate to China? So when we look at that closeness between countries and US and China respectively, looking at geoeconomic distance, looking at their trade intensity and also some of their investment relations, we find that most of the emerging world and especially the Asian countries are closer to China. And a lot of the large developed Western economies are closer to the US. Some countries are managing to strike a balance and stay at relatively the same distance between the US and China. Among those, we can cite Canada. Although Canada is a historical partner of the US, it also has strong ties with China through trade, through investment. Or we can also cite Australia again, which has been historically and from a geopolitical standpoint an ally of the US, but has also strong relations with China. And the key question is, how is this going to move forward? What we believe is that probably in those mid-sized economies, which are going or aiming to become middle powers, probably that both the US and China will try to steer them closer to them. And that means for those countries, more investment and more opportunities, because they will remain attractive, cheaper than China, and having the advantage of not getting the same trade barriers as China.
Thank you very much.
Thank you, Maria.
Thank you, Maria.
Thank you so much for listening. You can find the full report we just spoke about on our website. We'll leave a link in the show notes. If you'd like to discover more of our research, you can also follow the Ludonomics newsletter on LinkedIn. We'll leave a link down below for that too. If you like the podcast, please send it to any of your friends who might like it too, and leave us a rating and a review. We'd love to hear your feedback. In the meantime, stay tuned for the next episode.